Our next guest says today's hot inflation report in Trump's anti-growth policies might create opportunities in the bond market. Dam Spring Advisors CEO and Chief Investment Officer Andy Constan joins us now. Andy, always great to see you.
Hey, Melissa. How are you?
Which bonds?
Well, so I think what's happening is, and I heard it in the discussion before me, there's great policy uncertainty. And not only is there great policy uncertainty, there's not necessarily consensus on what policies will actually do. So, for instance, I think it's without question that the deregulatory environment will be disinflationary and pro-growth. On the other hand, immigration reducing the supply of labor is anti-growth. Tariffs are anti-growth. And expenditure cuts are anti-growth. Literally, the government spends less. That means the economy contracts. And those are the policies that I call the Trump policies that are anti-growth. And so the question is, what drives equities? That's what a lot of your audience cares about. And what drives equities isn't inflation. It's valuation, which is driven by how easy monetary policy is, and growth. And so it's not surprising to me that when you get a hot inflation print, bonds sell off. But equities don't necessarily have to sell off until there's a negative growth impulse. And I think that's heading our way. For instance, last summer, we had extremely accommodative financial conditions. We had robust government spending, and the Fed was signaling a cutting cycle. It's not surprising that the data that typically lags what are very easy financial conditions is showing up now as very strong data. However, financial conditions have aggressively tightened over since the September rate cut after the election, and then subsequent with additional cuts. Bond yields have risen a lot, and that has tightened financial conditions. And the Fed is on permanent pause. Not only is only one cut expected this year, but the yield curve is entirely flat for 3 or 4 years. And so that means no cuts are expected beyond this year. And so with tightening financial conditions and anti-growth policies, albeit one policy is still a tailwind, which is deregulation, it is an environment where you might get a growth slowdown.
So, Andy, it's Karen. Thanks for being on. We know the Treasury Secretary really sort of has the tenure as the mark of success there. The president often seems to want the market, thinks of the market. How at odds are those two things to get the tenure where they want it to be? Does that have to be?
Yeah, I mean, I think the 10-year responds to disinflationary, solid growth. Steve mentioned fiscal responsibility, expenditure cutting. All of those things are what, if I were announcing the policies that are being announced on the Trump agenda, what I would want to be measured against is falling 10-year yields. And I think that's what Secretary Bessent pointed to. And I think he's attempting to point his only important constituent, the president, to something that would make sense, particularly when the policies themselves may not be that great for equities in the near term.